Right. Mayuresh, Joshi is also now joining us on the phone line. Mayuresh, what's your first thought on Infosys numbers?
Good morning. Disappointing in terms of the guidance given, but again, it's very realistic in my opinion because all the factors that we have been talking about, currency headwinds, the rupee appreciation against the dollar, you're probably seeing repercussions happen out of Brexit. You're probably unsure on what Trump will do and Trump policies thereof. So that will be clearly exhibited in terms of the guidance given, both in terms of constant currency as well as the EBIT guidance given. Because one must remember they had revised their constant currency guidance last fiscal 3 times because of the uncertainties they have to face. So the transformation in their core businesses that are happening towards digital optimization and the client wins thereof, I think that's going to be extremely critical going ahead in terms of how client wins will happen on these fronts. And that will probably guide the company in terms of how the performance will be going ahead. The dividend payout probably a soother of sorts to probably allay investor fears. But to a large extent, I think the underperformance of IT companies might very well continue for all the headwinds that we're probably seeing in the global environment.
Right. An analyst from HDFC Securities is also now joining us, Mr. Apurva. He tracks Infosys very closely. Apurva, what is your first thought on Infosys numbers? They are weaker than expected?
Yes, so the prima facie does look slightly lower than expectation, both in margins as well as revenue is more or less in line. I think guidance being lower is again slightly more in nature of being conservative, and also the fact that overall IT services is slowing down as a segment, which is what we've seen with what Gartner talked about and some of the other global diversified players have been talking about. So that's pretty much in line with what's happening.
Right, but what does this weak guidance mean? Does that mean more EPS cuts, and it's coming off a weaker revenue growth, or a weaker sort of a number than what the street was expecting for FY17 in dollar terms? Does that mean that cuts could be slightly higher?
No, so actually we don't think the cuts could be higher. There could be marginal cuts. We have taken the fact that the takeoff towards FY19 would not be as smooth, and it'll be gradual. There are multiple headwinds which is there, so a lot of it could be to do with currency. There could be visa-related issues. So I think it's conservative for the management to buffer that with an additional 100 bips on the margin side. On the growth side, I think it's more of a sector trend, with what is happening on the legacy part of the business. So I think it's really about winning share within digital and scaling that up.
Right. In terms of valuations, do you think valuations are already factoring in that maybe another 5-10 rupee decline, and valuations would factor no growth or very low growth in the next year?
I think valuations is at 13.5 times FY19. I think a lot of it is factored. The fact that earnings growth will be between 7 to 8% CAGR over the next 2 years, I think it does factor in that trend. In fact, the positive is the payout. The increasing the payout is something which I think puts some floor to the stock price.
Right. Let's also welcome in another analyst from IDBI Capital. Urmil Shah is now joining us. Urmil, what are your first thoughts?
Yes, so the Q4 performance is a miss, and the FY18 guidance is lower than what we were expecting. We were expecting them to be conservative.
Yeah, Urmil, I think the audio is not that clear, but we'll just get that fixed and come back to you. Apurva, the valuation point that you were making and the payouts that they are likely to increase. Do you think that, as you pointed out, what sort of floor would it let the valuations be? 12-13 times is a good enough valuation?
Yeah, absolutely. So, currently it's at about 13.5 times FY19, which is, I think, very decent levels to look at accumulation in the stock, considering the kind of discount it is at, at historical levels of 18-19 times. So I think a lot of it is definitely there in the price. Improving capital allocation can definitely work wonders in the multiples. We've seen that happen with Accenture, with growth rates being 5%, sub 5%, and a strong buyback policy there, and we've seen how that has moved into a very strong premium over the overall Indian IT space. So I think as the sector matures, payouts would matter a lot more, and this should definitely help the downside, protect the downside rather.
Right. Can you just tell us that, when such payouts happen, or, what happens with some of the other IT companies, it takes some time before market realizes that ROEs have increased because of buybacks for continuous number of years?
Yes. So what is important is, this being a part of a consistent policy, and once it becomes a part of consistent dividend or consistent payout policy, then the market starts to factor that in. A one-off buyback, a strong one-off buyback, does not really help the cause. So I think a consistent policy, by putting it, framing it as part of a dividend policy, does help, which does add a lot of visibility too.
Right. Urmil is back with us. Urmil, can you just start again? What are your first thoughts on Infosys numbers?
So as I was telling, Q4 was a miss, and we were expecting them to be conservative in giving the FY18 guidance, but it's still slightly lower than what we were expecting. Importantly, on the operating margin front. The only positive is, as you were discussing, is on the capital deployment strategy that is clearly outlined. So that is, the only positive which we could see from, the information which is available right now.
Right, but can you just tell us that aren't valuations factoring in? We were also discussing about valuations with other guests, and everybody seems of the view that 13 times, 12 and a half times tends to factor in weak growth for next 1 year.
Yes, I would agree to that point, but there are still some headwinds in the near term. So from a 1 year plus point of view, yes, the valuation looks very attractive, but yet what is the final outcome that will come on the H-1B visa policy? Where does the rupee eventually stabilize? So these are some headwinds which are there for the next couple of quarters.
Right. What sort of EPS cuts on the street would you factor in?
I can tell about myself. So we were working with an EPS of 68.1, which was 8.5% growth on FY18. I think factoring the buyback, there should not be significant cut on that. I'm taking into account that because they have also increased the payout policy, and they have stated that payout might also include buyback. So I think they might do about a $2 billion worth buyback in FY18. So because of that, the cut which otherwise would have been done because of lower revenue will be offset.
Right. In terms of the point about buyback or the point about extra payout, how do you think investors would react to that? Would there be investors that are willing to pay 12 times for a good 70% payout?
70% payout is not that relevant. What is relevant is what is the dividend yield, because that is the kind of return that shareholder will get, and also the impact on the ROE. Keeping that into account, I think that yes, 12-13 times is attractive. But there are headwinds for the next 2 quarters. So from a 1 year plus point of view, yes, this valuation is attractive.
Right. Apurva, could you just tell us your EPS estimates for next year and what sort of dividend payout can be expected, or dividend yield if you could calculate that at 945?
Yes, so we are working with conservative FY18 EPS estimated about closer to 64 and 72 for 72.3 for FY19. We're not likely to significantly cut that. I do think it does become attractive with overall higher payout. We were working with a 50% payout, and that will substantially increase. So I think ROEs will get pulled up further and thereby becoming relatively more attractive.
Right. Can you just, Apurva, can you just tell us about valuations in context that, FIIs love this stock, Infosys, or any other large cap IT companies, because they've always been, the most overweight on this sector for years. Any hint of earnings recovery from Infosys or TCS or HCL? You think the valuation itself can re-rate, which could lead to a lot of gains?
So yes, there is definitely a case for valuations which can re-rate, with growth coming back. So as we're entering into relatively stronger quarters, the next couple of quarters, if a lot of growth is front-ended, I think that may probably support the valuations. As I said earlier, I think a capital allocation policy which is sustainable is definitely going to help in a long way.
Right. Apurva, could you also just tell us what to expect from TCS, HCL, or within the top 3-4 companies? Now, after Infosys is out, which company would you eye out for the sector leading growth?
Yeah, so I mean, within the tier 1 pack, we expecting HCL Tech to post the highest sequential growth. We're expecting about 3% or so dollar revenue growth, and TCS at about, followed by TCS at about 1.9%. There is some inorganic help that HCL Tech will be getting for this quarter. So that's the growth pecking order. In terms of our preference pecking order from the tier 1 pack, we do prefer HCL Tech, Tech Mahindra, and Infosys.
So HCL Tech is the top company that you would expect to do well.
That's correct.
Right. From the mid-cap space, any other company to eye out for? Next week there are a lot of mid-cap company results as well.
Yes, so mid-cap results are there. Within the mid-cap space, you can expect maybe a Zensar to be posting on the higher side. Cyient can be posting revenue growth on the higher side. So we do like Zensar and stocks such as Persistent and Emphasis.
Right. Apurva, thank you so much for taking out time for us. Urmil, could you also just tell us what do you expect from TCS? They declare on 18th.
Yes, on TCS we are expecting a 1% growth in CC terms, about 25 bips benefit from cross-currency movement, and we are expecting TCS to maintain their margins, in fact slightly improve by 16 basis point to 26.2.
Right. Any other names? HCL Tech, Wipro, where do you expect good growth or any surprise to come in?
Yes, so and HCL we are slightly more positive than the previous analysts. So we are expecting a 4.3% growth in USD terms. This would involve the organic growth of 1.4% in CC terms, and the balance coming from the two IP deals they have signed with IBM and consolidation of Butler, America Aerospace, and Geometric.
Right. Urmil, thank you so much for taking out time for us. On that note, we're taking a break. Coming